Ladies and gentlemen, today we're going to pick up, still talking about the 1920s, but we're going to be talking about something that we haven't really covered yet. And it's something that's kind of been, I guess, kind of lurking in the background of a lot of the other conversations we've had, but we've never gone in depth on it yet. And of course, we all know that thing is stonks. I don't know why I enjoy that strange mannequin man so much, but stocks. We are going to be talking about stocks today. So the first thing that we need to talk about as far as stocks are concerned is, what is it, or what are they? What is a stock? Clearly this mannequin man is mildly happy about his stonks going up, but what does that mean, right? So to explain this, we're going to use two different angles. One is from the business perspective, and one is from the investor's perspective. So from the business perspective, what is a stock? Well, let's say that you were running a business and you needed some extra capital, which is a fancy word for saying you needed money, whether that was to buy new equipment for your business, or whether that was to hire new employees for the short term to help your business grow. Whatever it was, you needed cash. Well, in order to get that cash, if you needed that extra boost, instead of waiting years to pile it up, you could instead do something called getting an investor. Now, that could be one investor, right? So you could just say like, hey, rich guy, if you give me $500,000, then I'll let you own part of my company. And that happens sometimes. But if you really want a big influx of money into your company so that you can really jumpstart your growth and use that to, build several new factories and expand your product line or whatever, and you really believe that it's going to grow your company in a profitable way, meaning you're going to make money off this proposition, then you can do this thing called an IPO, or an initial public offering. In an initial public offering, you are opening up a section of your company to be purchased by anyone who wants to buy it. And so you literally just say, hey, here's part of my company. I'm going to sell it so that you guys can actually buy a piece. So what are we talking about here? Well, we got to stop looking at the stonks guy for a second here and look at these. This right here is our stocks. Well, it's three different companies, right? So we've got our orange company over here, and we've got our nice little red company in the middle, and we've got our yellow company over here. Let's say that this company here is needing some money. Well, they could choose to approach some large investor and say, I'm going to give you this, right? I'm going to give you a third of our company, and in turn, you will give me $500,000. Well, now this company here has an extra $500,000 that they can invest in purchasing, like I said, new equipment. Let's say that they're a shoemaker, right? Then they can buy a whole new factory to produce shoes and therefore double their production of shoes. Well, hopefully for the investor, the person who just gave them the $500,000 for a third of the company, then the hope would be for him, that company then does actually double the amount of shoes that they sell. Because 1/3 of one factory's worth of shoes cost $500,000. If that doubles, then now the total value of his third might be worth $1 million because the company itself has grown, right? But we don't really operate on that scale usually. I own some stock. A lot of people own stock. Most of those people do not own a third of the company. For easy math, and the fact that this is the most complicated one I could find here, so thanks to Miss Penn for donating this for a brief time. But we're going to go with these as our representatives for normal people stock, right? These are 1/10 of the company. So why would you, as a normal person, ever buy a stock? Here's why. Let's say that this is a company. It might be something that like a friend of yours has started, or it might just actually be something that you're interested in, you think is going to do well in the future. Then you can look at it and say, you know, I'm going to buy in when they start offering stock options. So pretend that this is, you know, Apple computers in the 70s. And you say, I'm going to buy 10% of this company, 1/10. You purchase this piece not with the intent of like this piece of stock, which obviously would be like, you know, paper and documentation, not an actual little wedge, but your documentation showing that you own this 1/10 of the company. That could have gone badly. Doesn't mean all of a sudden, like, if you own this 1/10 of Apple, you get free Apple computers or something. That's not what it means. All of that stays in the business. But what it means is that you own 1/10 of Apple, no matter how much Apple, the company, is worth. Now, in reality, if you owned 1/10 of Apple, you would be a multi-millionaire. In fact, you would be a billionaire because Apple is now worth over $1 trillion. So if you buy in when the company is small, and then the total value of the company grows, your percentage of ownership stays the same, but the value of that ownership goes up. So, hi, I'm back. Let's look at that in practice here. No, not the stonks guy. But let's just say that we look at the stock market and we pull up a stock. So let's go Apple. This is Apple stock. It is currently worth $118. But if we zoom out as far as it'll go, let's go back to 1990. If you had purchased one stock, right, one slice of Apple in the year 1990, it would have cost you 29 cents. 29 cents. For every 29 cents you purchased in 1990, that same little slice would now be worth $118. So if you bought $1 worth, $1 worth, that would now be worth over $300. It'd be like $360 for $1. That's a 360% growth. No, that's like a 30,000. It's a ton. It's huge. The percentages I'm bad at. But so why would you buy a stock? Why would you choose to buy this? Well, your hope is that it does what Apple did, right? So you pay $20 for a stock with the hope that the company that you've bought that stock in is then going to grow, and your little piece, your little percentage is going to grow in value along with the company. So how does all that work? How does this happen now? Well, that brings us to another term that I've already used here, and that is the stock market. Because you as an individual, it's not like, you pick up your phone and call Apple customer service. Hello, I'd like to buy a slice of you, right? It's not what you do. You have to purchase stocks in this thing called the stock market. So the stock market is literally, it started out, we have one in New York, right? Now, if you started out in Europe way back when, but our big one is here in New York, and it is the New York Stock Exchange, NYSE. And the New York Stock Exchange, very literally, prior to all these electronic ways that we could trade stock, was a place where you would walk in and you would either hire a stock broker, someone who knew what they were doing, or you personally would go in and say, I got $20. I want stock in whatever company, right? And in doing that, you would actually physically trade. You would get pieces of paper that proved that you owned $20 worth of stock in X company, and you would give them the cash, right? Nowadays, most of that is all handled electronically through big organizations, things like Chase Morgan Bank and Fidelity, and there's some little ones. There's one that's called wait, let me look at it. It's called Robinhood, and apps, things like that. But they're all handled for the most part digitally. But the stock exchange then is the place where all of this buying and selling of stock in all the different companies in the United States happens. And the way that we measure how the whole thing is doing, the stock market, is through a series of averages. The most common one that is used is this, the Dow Jones Industrial Average. And essentially, what the Dow Jones Industrial Average does is it takes a subset of the market. It takes a bunch of random companies. Well, I shouldn't say random. It takes a bunch of companies that are the leading companies in their areas, and it averages how they're doing, and that gives us the Dow Jones Industrial Average. That's why it's called an industrial average, DJIA, Dow Jones Industrial Average. Now, if we talk about the stock market went up 300 points today, or the stock market dropped 1,000 points, or whatever, we're almost always going to be talking about here in America the Dow Jones Industrial Average, the DJI, because it's taking an average of what is going on at any given point in the market, right? It's taking the average of what is happening instead of just looking at one stock like an Apple, because there could be a day where Apple goes up $200 a share, which would be crazy, and I would enjoy that. And Tesla or something else drops $200 a share. Well, on average, the market stayed about the same that day, right? There's a bunch of happening value going up and down. So let's look at, over time, the 1920s stock market. That brings us, that's the stonks guy, to this. So this is the 1920s, all the way from 1920 to 1929. You can see a consistent growth of the stock market. In fact, it quadruples in value almost over the course of 10 years. That's pretty significant, right? That's some significant growth. During this time period, I mean, why not invest in the stock market? People were just throwing every bit of money they had, and some they didn't have, into the stock market. And heck, I would too. Look at it. If you invested, just for easy math, if you invested $1,000 in 1920, it would be worth $4,000 in 1929. If you invested $100 in 1920, it's $400 in 1929. You'd be dumb not to put your money in it, right? Nothing could go wrong with this, right? Now, what's really kind of cool is if you look at the Dow Jones Industrial Average from 1920 to 1929, and then we come back to the modern day Dow Jones, you might be like, oh, that looks different. Well, that's because this is just one day. You can zoom out 5 days, a month, 6 months, a year. You can see right here what happened. This is what happened when we did the coronavirus lockdown initially in March, dropped from 28,009 on average all the way down to 18,000. So it lost 10,000 in average value in that short amount of time in March. But then it's gone back up, and now it's almost back at its record highs. So why am I bringing up today's? Well, let's zoom out a year, 5 years. Right. let's just look at the 1920s and the 2010 to 2020. Well, it went from 5,000, 10,000-ish to 30,000-ish. Went from 100-ish to 300-ish. Huh. These look kind of the same, don't they? Well, I mean, that's great. It's good to look just like the 1920s because the 1920s were roaring. Right, guys? I mean, here's the deal. Hopefully, you understand the basics of stocks. You buy it, you sell it. You buy when your company is little, and you sell it when that company's little percentage that you own has gone up enough that you're like, I'll just take the money. You sell that percent. So if I bought Apple stock in the 80s for 29 cents or in the early 90s for 29 cents, and I sold it now for $128, I made good money. So as long as this thing keeps going up, everything's all good. So today we will end on that note. Would you invest in the stock market? Do you plan on doing it when you are old enough to? Or, I mean, if you have any kind of job now, you're old enough now to invest in the stock market. What do you guys think? Based on today's lesson, everything's booming in the 20s, guys. Everything's booming in the 2020s, 2010 to 20. Are you going to consider investing in the stock market? Here's what I want you to comment, or not comment, but answer. First off, would you actually consider it? Secondly, could anything ever possibly go wrong? Probably not. Right? See you guys next time.